The stock is trading at exactly $235.35, pushing upward by approximately 2.21% or $5.09 in today's intraday session on this abbreviated Black Friday trading day. While many market participants have stepped away for the Thanksgiving holiday weekend, the electronic order books are flashing green, indicating that the algorithmic liquidity providers and the few institutional desks actively staffing the floor are positioning themselves aggressively before the month closes. The volume is naturally lighter than a standard full session, yet the price action is showing a decisive rejection of lower support levels, maintaining a robust bid that defies the typical holiday lethargy. You might look at that green percentage and assume this is simply a sympathy rally, a case of Micron Technology drafting behind the broader semiconductor index, or perhaps just catching a ride on the coattails of an NVIDIA surge. That is the surface-level expectation, that Micron is merely a cyclical commodity stock, destined to rise and fall with the generic tide of the Nasdaq. But the reality is far more intricate and, frankly, far more explosive. What we are witnessing right now is not just a standard uptick, it is the early stage of a fundamental repricing of what memory actually means in the age of artificial intelligence. The market is waking up to the fact that Micron is no longer just selling storage space. They are selling the very bandwidth that makes generative AI possible. If you think this is just about selling RAM for laptops and smartphones, you are looking at a 2015 business model in a 2025 world. The expectation is that memory is a commodity. The reality is that high bandwidth memory, or HBM, has transformed into a luxury scarcity, and Micron is holding one of the few keys to the kingdom. Let's unpack the current tension between the memory is dead money narrative and the AI supercycle thesis. For decades, the investment thesis for Micron Technology was nauseatingly simple. You buy when the price-to-book ratio is low, and you sell when it hits historically high multiples, usually right before the spot price of DRAM, dynamic random access memory, crashes due to oversupply. That is the common ground most investors stand on, the fear of the cycle. However, we must challenge this deeply ingrained belief. While the legacy markets for PC and smartphone memory remain somewhat cyclical and are currently seeing mature or slower growth, the data center segment has completely decoupled from this logic. We are seeing a bifurcation in the supply chain. Standard DDR5 memory is one thing, but HBM3E, the ultra-fast memory stacked vertically on top of logic chips, is an entirely different beast with different economics, higher margins, and significantly higher barriers to entry. Micron is not just riding a cycle, they are helping build the physical infrastructure of the intelligence age, and the pricing power they command in this specific niche is shattering the old models of cyclicality. In recent trading sessions leading up to this post-Thanksgiving squeeze, we've seen Micron Technology stock successfully reclaim key technical levels, notably breaking back above its 50-day moving average, a signal that often triggers trend-following algorithms to flip from short to long. The volatility we saw earlier in November, where the stock dipped on fears of hyperscaler capital expenditure fatigue, has largely been bought up. Why? Because the data coming out of the supply chain suggests that the fatigue is a myth. The reality is that major customers are not slowing down. They are desperate for yield. Micron has confirmed that their HBM capacity is effectively sold out for the entirety of calendar year 2025 and is already fully contracted for 2026. Think about the gravity of that statement. In a traditional manufacturing business, having your production line booked solid for 2 years at premium pricing is the holy grail. It removes the guesswork from revenue projections and provides a floor for the stock price that the bears simply cannot argue with. When you look at the broader landscape of how people are accessing this trade, it is fascinating to see the divergence in behavior. You have the retail crowd, often trading via the Robinhood app or using SoFi Invest, who tend to react hypersensitively to daily headlines. If a report comes out saying PC sales are down, the retail sentiment on Robinhood stock trading forums often turns bearish on Micron. But if you look at the flow coming through interactive brokers trading platforms or the dark pool data associated with larger Fidelity wealth management accounts, the story is different. The smart money, the institutional allocators, are looking past the weak consumer electronics data. They are looking at the server racks. They are looking at the capital expenditure guidance from Microsoft, Google, and Meta. They understand that while a consumer might wait an extra year to upgrade their iPhone, a hyperscaler can't afford to wait a single month to upgrade their AI clusters, or they risk losing the arms race. This disconnect between the retail perception of weak consumer demand and the institutional reality of insatiable enterprise demand is where the alpha is generated. Let's shift gears to the fundamentals that are driving this specific price move today. Micron's recent financial performance has been nothing short of stellar, yet the market initially shrugged it off, creating the value gap we see now. In their fiscal 2025 performance, revenue soared 49% year-over-year. That's not a typo. Net income margins have expanded, and earnings per share skyrocketed over 500% from the trough of the cycle. The driver? The data center business unit, which now accounts for over 56% of total revenue. This is the pivotal statistic that invalidates the cyclical trap argument. When more than half of your revenue is tied to the secular growth trend of the decade, AI data centers, the legacy PC market matters less and less. We are watching a metamorphosis of the company's revenue mix in real time. Now, I want you to pause for a second and engage with this idea. We often talk about holding forever, but memory stocks are tricky. Comment below how many shares of Micron Technology you currently hold, and more importantly, tell me, do you plan to trim your position if we hit all-time highs in 2026, or do you believe this is a 10-year hold? I want to see where the sentiment really lies among serious investors. To understand why Micron is trading up today, we also have to talk about the competition. The memory market is an oligopoly, dominated by three players: Samsung, SK Hynix, and Micron. Historically, Samsung was the undisputed king, crushing competitors with volume. But in the HBM race, Samsung stumbled. They had yield issues. They struggled to get qualification from the main customer, NVIDIA. This left the door open for SK Hynix and Micron to grab market share. Micron executed perfectly. Their HBM3E product is reportedly 30% more power efficient than the competition, a metric that matters immensely when you're running a data center that consumes as much electricity as a small city. This technical advantage has allowed Micron to punch above its weight class. They are no longer the cheap alternative to Samsung. In the HBM space, they are the premium provider alongside SK Hynix. This shift in competitive positioning is partially what is fueling the bid that we are seeing on your screen right now. Let's explore the actual business model deeper, because understanding the how is crucial for staying in the trade when volatility hits. Micron manufactures two main types of memory: DRAM and NAND. DRAM is the working memory, the desk space where the processor does its thinking. NAND is the storage, the filing cabinet where data lives when the power is off. For years, the industry focused on shrinking the size of the transistors to fit more on a chip, Moore's Law. But we hit a physical limit. So Micron and others started building up, creating 3D structures. NAND flash is now built like a skyscraper with hundreds of layers of cells stacked on top of each other. But the real magic, and the reason the stock is near 235 today, is HBM. HBM involves taking DRAM dies, thinning them down to a fraction of a human hair, stacking them 8 or 12 high, and punching thousands of microscopic holes through them through silicon vias, or TSVs, to connect them electrically. This allows data to move vertically, creating a massive highway for information that is significantly wider than the old side roads of traditional memory. This is incredibly difficult to manufacture. The yield rates, the number of good chips per wafer, are lower than standard memory. This difficulty is actually bullish for the stock because it limits supply. You can't just flood the market with HBM because it's too hard to make. This natural supply constraint supports pricing power and keeps margins fat. The broader ecosystem also supports the bullish thesis for Micron. If you are a user of Schwab Intelligent Portfolios or you manage your own funds through a Fidelity brokerage account, you might have noticed the rotation into hardware infrastructure. It's not just NVIDIA anymore. Investors are looking for the pick-and-shovel plays. They are buying the cooling companies, the power utility stocks, and the